Hello everyone, welcome back. Now I am deliver my lecture on unit 5, that is bank account record report. It is the last unit of banking law. First of all, I give the definition of bank account. That what is the bank account? So bank account records are document that maintains the details of a customer's account transaction. What are its purpose? To track and maintain accurate financial history, to provide necessary information for audit, tax filing, and personal finance management. Now, how many type of bank account records are there? First is saving account records, detail of deposit, withdrawal, interest earned, and minimum balance. Second is current account record, which is in which detail of daily transaction, overdraft limits, and service charges included. Third is FD records, in which information on the deposit amount, interest rate, and maturity date. And fourth is loan account record, which include loan balance, payment interest charges, and loan tenure. Now, what are the key components of a bank account record? Let's see. First is account number, in which unique identifier for the account holder. Second is transaction history, in which list of all deposit, withdrawals, and transfers. Third, account balance, in which available fund after each transaction is available. And fourth is interest and charge, interest credited to saving or debited for loans account maintenance fees. Now next is procedure for obtaining bank account record report. First is online banking, in which access through the bank official website or mobile app. Second is ATM receipts, in which provide a summary of the last transaction. Third is bank visit, which requesting a statement of the branch via customer service. And fourth is email request, in which requesting an email statement or PDF version of account records. Now next is security measure in bank account reporting, which secured access, use of strong password, two-factor authentication, and encrypted platforms. Second is fraud prevention, when monitoring for suspicion transaction and setting alerts. Third is privacy protection, in which ensure personal and financial details are protected from unauthorized access. The next is common issue in bank account records reports. The most common issues which faced which comes under in bank account records reports are: first is discrepancies, mismatch between records and actual transactions. Second is unclear charges, hidden or unexplained services fees and penalties, delayed transaction not reflect immediately in the account balance. And fourth is fraudulent activity, unauthorized transaction or identity theft. Resolving issue with bank account records. Contacting customer service, in which reaching out to the bank support team to clarify discrepancies. Second is dispute resolution process, filing a formal complaint for unauthorized charges or errors. Third is monitoring and alert, setting up real-time notification to track transaction. Now I conclude this topic, and in which bank account record report is essential for tracking financial transaction, managing the personal finances, and ensuring the account accuracy of bank accounts. Regular monitoring it helps in identifying error and maintaining financial security. Thank you. Now we come to the next topic of unit 5, and that is some important some banks, that is IFCI, IDBI, ICICI, and Export Credit and Guarantee Corporation of India, in which you read about key financial institutions and their roles in India's economic development. Introduction. Overview. IFCI, IDBI, ICICI, and ESGC are pivotal financial institutions that contribute to the growth of industries, infrastructures, and international trade in India. What are its objective? Its objective is to provide long-term financing support in industrial growth, promote exports, and ensure financial stability. Now, what is IFCI? It is Industrial Finance Corporation of India, established in 1948. And what are its object? To provide long-term finance to industrial project and promote industrial growth. Industrial Development Bank of India, that is IDBI, established in 1964, and its object is to promote industrial development by providing financial assistance, including long-term credit to industries. Third is Industrial Credit and Investment Corporation of India, ICICI. It's established in 1955, and its object is to provide credit and financial services for industrial development and to provide investment in Indian industry. Now, what are the key contribution of IFCI, IDBI and ICICI? It promotes industrial growth. All four institutions have contributed significantly to the growth of Indian industries, including manufacture, infrastructure and services. The second is supporting infrastructure. They have provided long-term credit for large infrastructure projects such as power plants, roads and ports. Third is facilitating financial inclusion. Now, what the challenge faced by these institutions? Non-performing assets, that is NPAs. High level of NPAs, particularly in the industry and infrastructure sectors, which have implicated their financial stability. Over dependence on government funding. These institutions have faced challenging in raising capital without government support, particularly in their earlier years. Third is adapting to market changes. The shift towards liberalization. They shift toward liberalization and competition from private banks and financial institutions poses challenge to their operation. And fourth is financial reforms. Let's we see that lots of financial reforms is done by such type of institutions, such type of financial institutions. Now, let's come to the conclusion. And before we conclude this topic, I said about that IFCI, IDBI, ICICI and ESGC, these institutions have played an essential roles in the development of India's financial ecosystem. Because every country economy has gone up only when India's financial ecosystem got high. So these institutions, that is IFCI, IDBI, ICICI, these all three institutions plays a very pivotal role in the development of India's financial ecosystem. What are its impact on Indian economy? As I said that every country become developed only when their financial ecosystem goes high, and this IFCI, IDBI, ICICI, and ESGC, these four institutions plays a pivotal role in development of India's financial ecosystem. So what are its impact on Indian economy? Their contribution have been vital in promoting industrial growth. As we know that every country become developed only when their industries growth become developed. As we know that India is a developing country, and there are many industries which go high and regularly work to make India a developed country in place of developing countries. So their contribution, so these three institutions, IFCI, IDBI, ICICI, play a pivotal role, and their contributions have been vital in promoting industrial growth, infrastructure development, financial inclusion, and export competitiveness. Now, what is the future outlook? Future outlook, as we know that with ongoing reforms, privatization, and digital transformation, these institutions are poised to continue driving India's economic progress. Ongoing reforms, privatization of many, as we say that today we all say that all our government bodies become privatization. Government has gone towards privatization in place of publicization, and also for digital transformation. And ongoing reforms of this privatization and digital transformation, these institutions are poised to continue driving India's economic progress. So here I completed the full syllabus of banking law. Thank you. very much.